Thanks, Tim, and thanks for having me on ShareCafe, and everyone, thanks for joining us. So Chester started in 2017, as Tim said. There's three of us. We've all worked together for almost 10 years now, having come out of a previous boutique operation in Melbourne. Chester has $180 million under management, and we run a very high conviction benchmark unaware strategy. So the same team has run the same strategy for over 7 years now. And might just switch to the next slide, thanks. So what we do differently, we think, than a lot of our peers is, one, have a life cycle approach. So it's a very broad cap portfolio construction, and we think very heavily about capital protection. So we run a defensive sleeve through the portfolio, which enables us to protect the portfolio in down markets, often better than a lot of our peers do. Over 7 years, the fund has outperformed 80% of the time in down markets. So we think we're able to provide really strong alpha with a lower volatility using the portfolio construction tools at our disposal. We might just flick to the next slide, thanks. So the strategy itself is an Australian equity strategy. We can hold up to 20% cash, and we often hold, well, it's 25 to 40 stocks, and typically that's 34 to 35 stocks. And again, if we flick to the next slide, with just the performance track record over the last 7 years, we've generated almost 15% per annum over the last 7 years. Clearly the last 12 months was relatively pleasing from an absolute return perspective. While those returns are pleasing, the alpha generation, what we really like to highlight is the chart on the bottom left-hand side of that slide, which just shows you the correlation with the index. So our correlation is 0.867 relative to the peer group, which is 0.94. So that's how much your portfolio reacts with the index. So our portfolio has very low correlation with the index, and that's reflected in the lower standard deviation and the lower portfolio beta. And we think that's a testament to the way we run the portfolio construction piece. So again, we've had really strong alpha generation with lower volatility than the overall market, and certainly our peer group. I'll switch to the next slide, thanks. And look, the way we do this, and this is relatively simplistic, but the way we think about portfolio construction, and we think it's going to be really important in 2021. There's still a wide range of outcomes that can occur this year in terms of policy error and removing the world from the huge unprecedented stimulus that we had in 2020. So we have always allocated the bulk of the portfolio to what we call predictable cash flow growers. So those sectors are more likely to be healthcare, technology, infrastructure, gaming, staples, etc. Where a company has less predictable free cash flow or cyclical in nature, where it's energy or commodities or media or retail, we allocate a smaller part of the portfolio. And then we have always allocated a part of the portfolio to gold or an ETF that's non-correlated and cash. So we have a residual defensive sleeve that is positions that are non-correlated to the ASX 300. And we think that has really stood the test of time over the 7 years we've run this strategy. So if I just flick the next slide there. And again, in that context, this is how the portfolio has looked over the last 7 years. So the predictable part of the portfolio, those strong, visible, predictable cash generators, it's normally over 60% of the fund. If we're allocating money to cyclical stocks like mineral resources, that's always between 15 to 20% of the fund. And the defensive sleeve has tended to be 15 to 20% of the fund. So that's how the portfolio construction piece ties into what we think is a different offering than many of our peers. Next slide, thanks. I guess the other important point we'd like to make is that this is a broad cap fund. So in aggregate, it has a mid cap bias. So we do allocate a pool of capital to emerging companies, and we've got there as examples Aurelia Metals, which we think is compellingly unloved at the moment. Certainly some growth companies that still have the ability to grow their revenues in an organic fashion well above nominal GDP, and some mature companies where we think they have really strong industry positions. So that's how we sort of have a life cycle approach to the portfolio construction piece. Next slide, thanks. We can certainly answer these questions in Q&A if anyone's interested, but these are the top 10 holdings of the fund as of the end of December. Some of those companies might be well known to you, others less so. So what we'll do is call out a couple of these names we still think have significant upside over the next 12 months. But we certainly have to refer back to those companies if anyone's interested. Next slide, thanks. So the first one I'd like to talk about is OceanaGold. We were sort of interested in this in the low $3 range, and to be honest, it's been quite a problematic investment to this point. But what Chester does, we think, relatively well in terms of generating alpha, is finding unloved or undiscovered assets. So we think OceanaGold falls heavily into the category of unloved, and we see a really strong pathway because it's actually organic growth of their gold production growing from 300,000 ounces in 2020 to over 600,000 ounces in 2024-25. And that's, as I said, purely organic growth from their existing assets. OceanaGold has three main assets: Hale in the US, Waihi in the North Island of New Zealand, and Macraes in the South Island of New Zealand. They have an asset, Didipio, in the Philippines, which has been problematic in terms of having their mining license renewed. It would be a significant source of upside surprise if the Philippine government renewed their mining license in the Philippines. We exclude that from our valuation and our production profile. The main reason we think the market is getting this stock wrong is simply the world-class discovery they have at WKP, which is in close proximity to their Waihi mine in the North Island of New Zealand. They've had some spectacular hits, including 150 metres at over 11 grams a tonne. And we think this is truly unrecognised in terms of the value that will create for OceanaGold in the next 5 years. They've actually come out last year and said the production profile will grow from 50,000 this year as they restart the mining at Waihi to over 300,000 ounces by 2027 as they reach that WKP ore body. So using the Hale, which is going to produce 180 to 200,000 ounces, Macraes, which does 160 to 180,000 ounces, and growing Waihi from 50,000 ounces this year to over 300,000 ounces, we can see production of this company doubling over the next 4 or 5 years. So it's trading about $2.30 a share, and we see value genuinely above $6 a share. So we think it's well and truly in the camp of unloved and underappreciated assets. Next slide, thanks. This slide has probably changed slightly because News Corp certainly had a very strong run the last couple of weeks since it reported its 2Q results. But simply, we thought News Corp was incredibly underappreciated in terms of the assets it held in its stable. There's a very strong visibility of realestate.com, which News Corp owns 62% of. And realestate.com has risen from $40 to $160 in the last 5 years. Again, News Corp owns 62% of it. So while realestate.com was up 400%, News Corp went from $20 to $20 over that same 5-year period. So either the value of real estate to the News Corp company valuation was being completely unrecognised, or the rest of the portfolio was completely unrecognised. Now, the other main significant part of the News Corp asset base is a company called Dow Jones, which is the publisher of the Wall Street Journal and Barron's. And the green line there, if you can see the chart, is the New York Times, which is the closest comparable to Dow Jones. And Dow Jones actually had stronger subscriber growth than New York Times over the last 3 years. And that's sort of just new subscribers to the Wall Street Journal. So if we look at the way the market is trading the New York Times and the value of the New York Times, we think, including the live valuation of real estate, we think News Corp can easily be worth between $35 and $40 a share using what we'd still consider to be relatively conservative cash flow multiples. So the earnings for News Corp last week were upgraded by 50% on not only realestate.com, but really strong cash flow growth out of the Dow Jones asset and HarperCollins Publishing, and even Foxtel, which is showing signs of life. So the complete portfolio of assets within News Corp, we think are really starting to be recognised properly now, but we still think there's more to go in 2021. I might just flick to the next slide if we can. And I'll finish with this slide and then I'll take some Q&A. So where are we today? So these are the main themes we're looking at. Clearly, it's very apparent that the Australian economy is flying. So if you look at building approvals and consumer confidence, car sales, etc., we've exited 2021 better than any other developed nation. The RBA language from last week suggests they're going to let this run into the first half of this year. So I think it really augurs well for sectors and stocks that benefit from this economic tailwind that we're currently experiencing in Australia. Probably the biggest wild card in 2021 is what happens to inflation. Given the money supply growth that happened in 2020, how does that manifest itself as the world becomes unlocked, or people start remobilising after lockdowns in the Northern Hemisphere, after the vaccine has been rolled out across those populations in Europe and the US. So once we think we see people moving again, we think that's when inflation really starts rearing its head, and that probably would be really cause for concern on these higher value, long duration assets, the tech companies that have seen such unbridled enthusiasm for the last 5 or 6 years. So we think this year is far more likely to see a rotation in style because of the inflation that's going to be caused in the second half of 2021. The last point I'll make is, we've always been relatively cautious on technology because we think it's a very asymmetric bet. The winners take all, i.e. an Amazon, and there is a large cohort of investors right now willing to bet on loss-making tech companies in the hope that they get that asymmetric payoff. So we think there's a large amount of tech companies listed, both in Australia and the US, that are loss-making, and we don't see the visibility of how they become profitable in the next 3 years before they actually get disrupted themselves. I'll use a very quick example, and then I'll throw to Q&A, but if you look at a company like Tyro Payments, which is actually a good business, it's a terminals business that provides FPOS facilities for cafes and restaurants. So this listed last year with a $1.5 billion valuation. It's loss-making. Through COVID, obviously those cafes and restaurants were shut down. But what happened through COVID was an app-based product or solution created by Square, a US company, that allows you to go to a cafe or restaurant and order your food and drinks from the app on your phone. Therefore, the terminals that you're going to pay that were using Tyro are no longer being used. And so we think Tyro is actually a business model that was loss-making that has been disrupted in the last 6 months because of the changes to COVID rules and the way waiters actually bring food and drink to your table. So we're always very cautious about overpaying for assets so we can't see what they look like in 3 years' time. And I think it's going to be one of those trends to watch in 2021. So I'll leave it there. I realise I'm slightly over time, but I'm happy to take some Q&A if there's time.
Thanks, Rob. So that defensive nature of your portfolio, how did that perform during the March volatility and the downturn?
Yeah, so Tim, and I think that's what I've sort of referred to in terms of having our portfolio having lower volatility. If you look at March, for an example, I think the market fell 21% or something of that magnitude in March, and our portfolio fell about 16%. So it's certainly, we are a long-only product, so we're not going to be able to have gains in that particular period of time, but we've been consistently able to demonstrate that we fall less than the market in those volatile periods, and that's largely gold. Now, gold has actually been a really problematic investment the last 4 months because it's been used as a funder for the cyclical recovery taking place. But if we see inflation occurring in the second half of 2021, we think gold is absolutely going to have its time as a portfolio holding again, and a lot of people will revisit it. So we think it's certainly very appropriate to have an allocation to gold in the portfolio.
And there's a couple of generic questions here on your view on tourism and travel stocks.
Yeah, again, so I haven't been particularly enamoured with the travel stocks, largely which is sort of looking at corporate travel and Webjet particularly. They did such a large capital raising in March, April, I think you'll find the market caps of both those companies are well and truly above the market cap at their peak last January, February, because of the number of shares on issue. So we think that probably, given the uncertainties around how travel opens up and the lack of confidence I'm seeing and talking to people about what their business travel intentions are over the next 12 months, I still think there's a large range of outcomes in terms of what travel looks like the next 12 months. So for me personally, it's just a little bit early to wade into those particular stocks. I have taken a position in SkyCity. I think it's unloved, but if you look at what they were earning in 2019, SkyCity's only ever had 5% of their revenues from VIP or international travel. So 95% of it is the domestic market. And so we think as Auckland, people are moving about in Auckland again, those SkyCity casino numbers should stabilise. And I think, there's probably 30-40% upside to the SkyCity share price from here.